Hello there, I'm Nick Hopwood, founder and president of Peak Wealth Management, and welcome to the Peak Wealth 3Q review for the third quarter 2016. In this report, we will be sharing some of the important things we're looking at with the economy and markets. And so far, this year's been a slow growth year with 1.4% real GDP growth in the latest quarter. Job growth has been strong, and inflation remains low, and a slowdown in China and Brexit fears faded over the first 3 quarters of this year. We're in an aging expansion, and we have the upcoming election. Let's get to it. After a long bull market in stocks, a key concern is whether or not the market is overvalued. The chart shows the forward PE ratio over the past 25 years. That's the price of the S&P 500 divided by the annual earnings at the time expected by analysts. Overall, it shows that the market is a bit more expensive than average, but we do need to consider and factor in the relative value versus other investment asset classes. Many argue with the current low interest rate environment, it's justified to have a slightly higher valuation for stocks. Corporate profits have taken a tumble over the past 2 years, but what do we expect next? On the left, we see quarterly earnings since 2001. Which peaked in 2007 and plunged into the financial crisis and actually went negative. Since then, they've had a nice recovery and peaked again in 2014. On the right, we see how the surge in the dollar and the drop in oil prices have negatively affected the overall earnings per share. Simply put, the surge in the charts on the right help explain the problem with the chart on the left. And as oil prices rebound and the dollar stabilizes, earnings should resume an upward track soon. We all know markets don't move in a straight line. In fact, the average intra-year decline is 14%, as illustrated by the dots on this chart. 75% of the time, though, the markets end up positive. And you can see on this chart, after each correction, the market has recovered. We did have several years without a 10% sell-off, between 2001 and mid-2015. But then we had 2 in the last year, August 2015 and earlier this year in February of 2016. History is on the side of those who do not overreact to market corrections and short-term volatility. With the Fed threatening to raise interest rates and the upcoming election, we are expecting more short-term volatility ahead. The recession ended more than 7 years ago. Although some people talk as if we've never recovered at all. This page can help explain why some folks feel that way. On the left-hand side, we're measuring the length of each expansion measured in months. History shows the business cycle is lasting longer and longer. In fact, we're now in the 4th longest expansion in history, lasting over 84 months at this point. And on the right, we see the trajectory is the lowest in history, with 2.1% as the average GDP growth. Some speculate our lower than average recovery is due to slow growth in labor force and productivity and too much regulation. On the right hand side, we see the sources of growth in the last quarter of GDP. And on the left, we see that we're expanding, but it has been slower than in the past. It also shows the same major takeaway from the last slide. The economy is growing, but slower than in past business cycles. Near-term trends in the economy can be explained by the cyclical sectors. On the top left, we see car and truck sales. They've been very strong. Manufacturing and inventories are on the top right. They've been looking a little weak over the past couple of quarters, and they could continue to be a drag. And on the bottom left, we see housing starts. Still below average, but continuing to recover. On the bottom right, equipment sales. They remain suppressed. Companies are just not spending. This shows a mixed picture, which suggests a moderate economy going forward. Good, but not booming. Now that we've talked about the short-term drivers of economic growth, that is, the cyclical sectors, now we can turn it over to long-term drivers, such as population growth and productivity growth. Growth in working age population is shrinking, and the percentage of folks who are working age who want to work is near an all-time low. Also, growth in structures and equipment is at a generational low. We need good equipment and better technology advances to enjoy productivity growth. Given this, it's no surprise that productivity per worker has decreased, which contributes to slower growth as seen in the chart on the right. With less working age population growth and less productivity, it's no surprise we've seen a less than stellar GDP recovery. In conclusion, we hope that you really enjoyed this brief 5-minute presentation, and we hope that we can get together soon and review your situation as we head into year end. We can update your projections on planwithpeak.com and review the third-party institutional managers that we've selected on our award-winning UMAX platform. And we hope to see you on October 29th for the annual Michigan State Viewing Party. Thanks and have a great day.